Brad Martz. This is Lana Castle. We're here to talk about commercial property insurance. So it's an exciting topic, believe me. We're American Coastal. We were founded in 2007, in part by BB&T, now Truist Financial Corporation. We were spun out of that umbrella back in 2016, merged with a different company. I was CFO from 2012 to 2024 when we hired Lana. She is our CFO currently. I became president of the company in 2020 and CEO earlier this year. So we've got an amazing team, amazing track record of success in Florida, having earned an underwriting profit every year of our existence since our formation in 2007. But it's a secret. You know, this company it's flown under the radar. We're small cap, we're majority insider owned. Market cap just under 600 million. Price to earnings sub 6. But we've, again, been consistently profitable for 18 years. I think 18 years makes a trend. So we expect that to continue and having a very strong 2025. So with or without hurricanes, this is a company that's built for long term. We expect to earn an underwriting profit even in a quarter where we have a major hurricane loss, and we expect to be profitable for the full calendar year when we have multiple, up to 3 major hurricane losses in Florida. So we underwent a strategic transformation in 2022, 2023, where we completely divested of our personal lines business. We used to have a much larger personal lines homeowners business combined with the commercial, and the personal lines results were not great. They were masking the underlying performance and success of this gem we have with American Coastal. So in 2023, we completed the divestiture of personal lines in Florida, and later in 2025 exited the rest of our personal lines by divesting of our last remaining underwriting entity in New York. So we used to write in 17 states, billions of dollars of premium. Now we're just focused in Florida, writing commercial property only. So why? Why are we just focused on commercial? Well, commercial is far less immune to some of the regulatory restrictions, political constraints, and challenges in writing personal lines. Personal lines, businesses like homeowners tend to be businesses of size and scale and market share, but you're subject to constraints on your pricing, your underwriting rules, and your forms from regulatory oversight in the various states you operate in, including Florida. So the primary advantage we have in commercial is that we've got freedom of rate. We can charge whatever the market will bear for our pricing for our products, and that is super important in a very dynamic, rapidly changing insurance marketplace where you can imagine loss costs, reinsurance costs can change in a heartbeat with the threat of climate change and natural disasters. So we're through that transformation. We've spent the last 3 years essentially building a foundation, proving that this standalone business is as accessible as advertised, and hiring underwriters, building an underwriting team internally to enter the next phase of the company's development, which is now expansion outside of Florida. Historically, 100% of our commercial business was underwritten by a company called AmRisc, used to be affiliated with AmRisc under the Truist Insurance umbrella. We still partner with them. We have an exclusive relationship with AmRisc in Florida. They are one of the largest commercial property MGAs in the United States, today owned by Stone Point. And a very successful operation, and we look to deepen our relationship with them outside of Florida as they write substantially more business outside of Florida than in Florida. So that is one avenue for growth and partnering with them, as well as our own MGA internally called Skyway Underwriters. Skyway is the platform where we today are writing non-condominium commercial residential business, so primarily apartments and now assisted living facilities. So we write that stuff directly ourselves internally, accessing the same distribution network that we use with our partnership at AmRisk, but our exclusive relationship with AmRisk is for condo only, Florida only. So now the opportunity to write condos, apartments, assisted living facilities beyond Florida will be done non-exclusively both with AmRisk and internally with our own MGA Skyway underwriters. We have a #1 market share in Florida. It's a mature business. Again, we've been doing it 18 plus years. So the question is, how do we export those capabilities into other states? This is our investment thesis. It's relatively straightforward. Our business is highly specialized. That's the #1 takeaway. AmRisk has been so successful, and American Coastal has been so successful because of the time and money we've spent developing our proprietary underwriting model and pricing model. So data is the lifeblood of the company. Data quality is everything. We inspect 100% of our risks. We are an underwriting shop. Risk selection is everything. So we're focusing on the best of the best in terms of what we've got in Florida. As you can imagine, there's about 17,000 condominium associations in the state of Florida. We write about 4,200 of them. We've seen all 17,000 over the last 18 years. We know what good risk looks like. We feel like we've got the cream of the crop. It's a very sticky business, consistently profitable, again, done on an exclusive basis with AmRisk. But we're not retaining all the risk. We're transferring a huge amount of our risk to third-party capital, to the reinsurance community. Reinsurance is insurance for insurance companies, if you're not familiar with that concept, and I'll let Lana talk a little bit more about that. But our future and our expansion for growth and opportunity to grow earnings is primarily going to come through Skyway and the building of a new excess and surplus lines insurance carrier that will, in conjunction with AmRisk and Skyway, this new E&S company will begin to write commercial property outside of Florida. And you're not going to see us get off strategy. We're going to stay focused on what we know best. Profitability, you can see over time, this company has been historically profitable, but commingled with our old personal lines business that was discontinued in 2022, the results have changed dramatically, and we've had a nice tailwinds from a nice hard market where pricing and terms and conditions have been favorable over the past few years, limited catastrophe loss activity. But again, this year we took a $30 million retention against potential storms. If that were to have happened, that's how you risk adjust our earnings. It's pretty simple business from that perspective, but always profitable. A little bit more about AmRisk, 6th largest broker in the US, 7th largest in the world. They write about $1.8 billion of premium nationwide in commercial property, and we'd like to provide capacity to them and have a slice of that risk. Zero chance of adverse selection, a trusted partner that we can grow with. AmRisk was founded by our chairman and largest shareholder, Dan Peet. So he was the founder of both American Coastal and AmRisk, and we've enjoyed a great trading relationship with them for a long, long time. Our underwriting strategy is pretty simple. The first box tells it all. That's the mantra inside the company. Underwriting profit is job one. We get questions all the time about our investment strategy, and it's rather boring. We don't take asset risk. We have a capital preservation strategy with the assets under management. It's 90% investment grade fixed income, 10% S&P 500 index, pretty simple. We need to earn underwriting profits. The investment income is gravy on top of what we do. The rest, I will just say that our target market is between 5 million and 60 million of average insured value. Is around 16 million. So that's the niche we focus on. There's a lot of risk there. It's super dependable, super profitable, and we know which risk characteristics drive profitability long-term through extensive experience and reverse engineering of some of these hurricane models and sophisticated tools that try and quantify what the expected losses from a major hurricane would be. That's our secret sauce. Underwriting discipline has served us well through hard and soft markets over time. We probably need to extend this chart back to 2007 so you can see the ups and downs. The last softening cycle we had was really from 2014, 15, 16, leading into a bottom in 2017, and then Hurricane Irma hit Florida, came into Naples, borderline Cat 4, Cat 5 strategy, and loss costs were higher than expected. Litigation ran rampant, got out of control, ended up resulting in some tort reform in Florida over the past few years, which has been great. It's stripped a lot of the expected loss out of our future results, which has led to pricing coming down, as well as our largest cost is reinsurance. We cede about half of our premiums to our reinsurance partners. Those have been coming down as well. So our rates and what we charge for our products are always going to be based on expected losses. It's just a multiple of expected losses. Reinsurance is priced the same way. So the rates we charge will follow our reinsurance costs over time. We are entering a softer part of the cycle today where between tort reforms and limited hurricane activity, pricing is coming down, but our margins have remained intact. That's the good news. We don't need to talk about valuations, but this is a slide for the insurance people in the room that love to talk about, okay, well, what's helping support premium levels? Well, valuations continue to increase. We write a replacement cost policy. We have endorsements and options for actual cash value, which is depreciated value, to offer lower rates to people who want that type of coverage. But full replacement costs is sort of the default view in the state of Florida. And we've been keeping up with that over time, which is super important when you get into cycles like we're in now, where competition and new money is chasing the great returns we've had over the past 3 years. Now I'm going to turn it over, before I turn it over to Lana, just want to talk about the importance of reinsurance to our company for a second. You know, we're taking low levels of retention. That's the easy part to remember. As a percentage of capital, as a percentage of earnings, those are likely to be consistent over time as capital grows, earnings grow, but this is how we protect the balance sheet.
Thank you, Brad. As Brad just mentioned, I will spend a little more time talking about reinsurance because it's essential for an insurance entity to be able to transfer risk in a robust way. Our main reinsurance is, of course, catastrophe reinsurance, which means all named hurricanes. There is a perception that insurance companies have a lot of volatility, and as such, their earnings power is high, is difficult to predict. However, we think with the structure we have in place and the retention we have in place, our model is pretty straightforward, just needs to be adjusted for the retention. Our current exhaustion point is 1.3 billion, and the retention is about 30 million on the first event and 18.5 million on the second event. As Brad mentioned, this retention is subject to change depending on where our surplus is, but at all times, we want our retention to be an earnings event and not a surplus event. So the way we look at our reinsurance program is to be able to be profitable in any particular quarter with one event and being able to be profitable for the entire year with 3 hurricane events.
Exhaustion point, I should state that, is everyone familiar with the 100-year storm? Everyone's heard that term, but does anyone really know what that means? Doesn't mean once every 100 years. It means a 1% probability of occurrence, a 1 in 100, 1% probability of occurrence. We're buying to the 250-year return period, which is obviously significantly. 1 divided by 250, about 0.4% is sort of the probability or expectation of a major hurricane using all of our reinsurance, which once reinsurance is gone, obviously gets back into earnings and capital. So we never want that. This is a risk remote sort of event, black swanish, if you will, but it's quantifiable. That's what's so frustrating about insurance that people don't understand. This is lower volatility than people would expect. They see or hear hurricane, run for the hills, no questions asked, it's tangible, it's scary, right? But quantifiable, measurable, transferable. That's the secret.
Yeah,
Sorry.
thank you, Brad. No, that was a great clarification point. New for 2025 was our catastrophe aggregate reinsurance program. We put it in place to further protect us against this volatility that Brad just mentioned. So our current coverage is up to 40 million, which covers all perils with 20 million per occurrence. And we think this program just further protects our earnings in the event where it's going to be high severity, high frequency type of season. AOP stands for all other perils. So look at it as all weather events that are not named hurricanes. So our current coverage is up to 100 million, and the retention is generally limited to 10 million. The protection on the top is very strong for us because looking at the events historically, so far we haven't had an event that was in excess of 22 million in this program, but nevertheless, we do think it's a very important program to have in place, given again that some of the years might have these non-hurricane type events that will cause significant damage to the underwriting results. With this program in place, once again, we are protected. Excess per risk reinsurance, it's for non-catastrophe type of events. Current coverage is up to 60 million with a retention per risk of 4 million. This protection is designed for the events like fire and water damage, excluding flood. I think it's important to mention about our product, we do not cover any flood damage. So all the property damage that we get has to originate from non-flood type of events. Brad mentioned how important it is for us to further improve our growth engine and diversify our portfolio. As a result, we created Skyway. In 2025, we have a very modest goal of about 20 million of written premium. We'll come close to meeting that goal. Skyway will continue to grow with our additional products, and the risk profile currently is apartments and assisted living facility, very similar to the Condor type of profile. With assisted living, this is very new. We just introduced that program a month ago, given again very similar characteristics in terms of the risk profile. And additionally, we think these risks are very well maintained, given that usually somebody is on the property 24/7. So that fit our underwriting criteria very well, and we plan to expand these products in 2026 and beyond. This slide just gives you an overview of our consolidated financial results. Our core return on equity is almost 38%, a very strong result. I will not go in detail on all of the numbers here. Those of you that are interested can, of course, review our detailed Q&K filings. I think what's important to mention here is our net earned premium has grown in 2025 because we can always manage it as part of our insurance program. We have the quota share in place, and in 2025 it was reduced. So as a result, our net premiums earned increased. So sometimes even if you don't see the growth on the top line, which is direct written premium, we can still increase our earnings overall by managing this reinsurance program. Balance sheet, current stockholders' equity is about 1.2 billion. You can see that our investments, cash and cash equivalents, have continued to grow, given strong underwriting results. We're very conservative currently on our investment thesis. Mostly it's NIC 1 and 2 type of securities, fixed income. Some of that is in equity right now. We have a few alternative investments, but it's very material to our current portfolio. Growth and liquidity and shareholder value, summarizing all the results that we've had over the last few years and our historical trend of profitability. You can see here the increase over time. And in 2025, in January, we paid the special dividend of 50 cents per share. We just declared special dividend in January of 2026 of 75 cents per share. We currently think this is right method to distribute values to shareholders because, again, given that we are in a market that does have some volatility, having that flexibility is important versus potentially having their quarterly dividends where we might not be as flexible as we can be with the special dividends. Our capital allocation thesis, we get a lot of questions about our capital allocation and what we plan to do with our current capital. We're in a great position right now being overcapitalized. Those of you familiar that are with insurance company results know that we are measured by risk-based capital, which currently is over 1,500%. Target should be about 500 to 600, which is still way above the regulatory requirements. So we are pretty much have double the capital we need in our insurance entity right now to support the current level of writings. That being said, to support our growth initiatives, we do want to have that in place. We are in the process of forming an ENS entity that will require some capital. We do have 150 million of debt currently on the books. By about 2027, 2028, we do plan to reduce that leverage ratio. Our overall target is less than 25%, and we are currently on track to be meeting that target. Currently, in terms of buybacks, we also get a lot of questions about buybacks, and it's under consideration, but I think it's important for us to manage float. Also, we are majority insider-owned companies, so we don't want to further restrict the liquidity. But nevertheless, right, we always discuss it at the board level, and in terms of special dividends, quarterly dividends, or shares buyback, at all times we'll choose what's the best for the company and for the shareholders. This concludes our presentation. Unless, Brad, there is anything you want to add to my portion before we open it to the Q&A.
Thanks, Lana. I would just suggest that, we're valued primarily price to book today. I think the valuation has got us wrong. It should be more based on price to earnings. I think we fit the growth and valuation bucket extremely well. That's my humble opinion. Yes, sir, you had a question.
So should you be looked at as kind of like if you could go way back and look at how Markel was a lot smaller and was focused in one particular specialty category, and then they kept building out and finding other unique niches, and just kind of, not to say that you're going to do that, but look at you as kind of like a Markel way back when?
100%.
Do things?
Yeah, I mean, we're going to stay focused, at least in the short term, on commercial property. That's our area of expertise. Obviously, Markel today is writing all kinds of property and casualty. Casualty business, liability business is not our thing. So when we talk about assisted living centers, for example, we're not taking that casualty risk. No wrongful death lawsuits for us, just the property. But over time, absolutely. I think that's how this company will evolve. And Markel's an outstanding organization. They have been a reinsurance supporter of ours in the past. And there's obviously a much larger premium opportunity outside of Florida than there is just inside of Florida. So as long as we stay disciplined, target the right risks that produce the right return on capital, you will see us evolve that way.
What is the tail on your business? Is there much of anything at all? Since you're out of cap?
Yeah, not really. Tail risk, and I would consider it a short tail line today in property. That wasn't true. I couldn't say that a few years ago prior to tort reform because people had 3 years to file claims, and then with excessive litigation, we still have open claims from Hurricane Irma. I could count them on 2 hands and 2 feet, but they're out there, and that was turning what was supposed to be short tail into long tail business. But now you only have 12 months to file a claim in Florida. That is going to cut off the development significantly, which is leading to lower reinsurance costs, better margins for both the reinsurers and for us, and lower premiums for consumers. So the tort reforms are doing their job, and yeah, the shorter the tail, the better. The more predictable the losses are, the better. But our business will always be inherently unpredictable. That's the nature of cat risk, and why I would consider us a specialty underwriter. So today we kind of
With more than 6,000 small and micro-cap companies listed, if you're looking for the next Apple, then Channel Check truly is your trade. It's an investor community where you can access independent Wall Street research, advanced market data, balanced news, corporate videos, and podcasts. You can even register to attend in-person Meet the Management Series lunches, and to be part of the preeminent annual Small and Micro-Cap Investor Conference, NobleCon. And here's the best news. Since Channel Check is sponsored by the featured companies, premium membership requires no investment. It's absolutely free. So check it out. Log in today. Find out why Channel Check is North America's leading source of research on the companies that just may change the world.